Markets braced for impact as Trump floats a staggering 80% tariff on Chinese goods. The question now, is this policy or provocation? Donald Trump has proposed a sharply elevated 80% tariff on Chinese imports, calling the number one that seems right in tone, but leaving the actual decision to Treasury Secretary Scott Bessent. The comment marks a dramatic shift in rhetoric, pushing beyond previous trade measures and reigniting speculation over a return to aggressive economic nationalism. By shifting the burden of decision-making to Bessent, Trump signals intent while preserving flexibility, leaving markets, allies, and rivals uncertain about whether this is policy in the making or political leverage. Such a tariff, if enacted, would mark a major escalation in US-China trade tensions and ripple through global supply chains already strained by geopolitical fragmentation. It's a bold headline, but for now, the policy clock is in Bessent's hands. While Trump's message grabbed headlines, the real negotiations are set to unfold in Switzerland, where economic strategy meets diplomatic pressure. Trade negotiations between the United States and China are scheduled to begin in Switzerland, with Treasury Secretary Scott Bessent and U.S. Trade Representative Jameson Greer leading the American delegation. The location reflects a neutral setting for high-level talks, but the stakes are anything but neutral. With tariff threats looming and global markets on edge, both sides face pressure to deliver substance, not symbolism. Greer's presence adds strategic weight. Known for his hawkish stance on trade enforcement, his inclusion signals that Washington is not entering these discussions passively. Meanwhile, Bessent's role suggests an attempt to balance assertiveness with technical expertise, critical in navigating not just policy terms, but also market sensitivities. This delegation structure may also reflect internal calibration within the U.S. administration, merging political messaging with technocratic grounding. But while officials prepare to talk, markets are already reacting, signaling investor doubts about what these negotiations can truly deliver. U.S. financial markets are responding cautiously ahead of the upcoming trade negotiations between Washington and Beijing. Both the Nasdaq and the Dow Jones Industrial Average posted slight declines, reflecting investor skepticism about the outcome. This subdued movement suggests that markets are pricing in uncertainty, not just about whether a deal will be reached, but about its durability and scope. Investors are weighing the risks of political theatre versus concrete economic progress. The presence of hardline negotiators has amplified expectations, but also the possibility of stalemate. Even minor signals from the talks could trigger volatility as markets remain highly reactive to policy direction in an election-heavy environment. And while investors hesitate, central bankers are warning higher tariffs could bring not just uncertainty, but inflationary heat. The Federal Reserve has issued a warning that elevated tariffs could contribute to renewed inflationary pressure, especially as consumer capacity to absorb rising costs has been eroded after years of persistent price increases. This comes at a fragile moment. American households are no longer absorbing shocks as they once did. Real wage growth has stalled, personal savings have declined, and consumer credit is climbing. Layering high import tariffs on top of this backdrop could directly increase the cost of goods, especially in categories like electronics, apparel, and basic household items that depend heavily on Chinese supply chains. For the Fed, already navigating a delicate balancing act between controlling inflation and supporting growth, this adds a new policy complication. Rate cuts may become politically desirable, but economically unjustifiable. If the Trump tariff proposal materializes, the Fed could find itself managing imported price shocks at a time when core inflation was just beginning to show signs of cooling. While the Fed warns of internal strain, Beijing may be entering the talks with an edge, consistency in strategy and personnel. In the upcoming trade talks, China appears to hold a structural advantage. Continuity. Beijing has maintained a stable team of negotiators across multiple rounds of discussions, while Washington's approach has been fragmented by frequent changes in administration and shifting policy priorities. This institutional consistency allows China to preserve institutional memory, reinforce long-term objectives, and execute strategy with fewer internal contradictions. By contrast, US negotiators often face reset conditions. With each administration, priorities shift from enforcement-focused strategies to market access, then to geopolitical containment. This lack of policy durability can weaken leverage. It also complicates trust building. Beijing negotiators can point to earlier US commitments that were later walked back or reframed, raising questions about reliability. In high-stakes diplomacy, continuity isn't just administrative, it's strategic capital. And right now, China may be deploying that capital more effectively. And if negotiations succeed, China may be the first to de-escalate, with signs of tariff relief emerging as early as mid-May. China may lower its retaliatory tariffs to below 60%, but only if the current trade negotiations with the United States yield concrete results. The earliest this reduction could occur is mid-May, a timeline that has not gone unnoticed by market observers. The potential rollback would mark a notable softening of tone from Beijing, offering a calculated signal of flexibility. Rather than a full-scale de-escalation, it would be a measured gesture aimed at preserving leverage while showing willingness to engage. Mid-May is not a random marker. It coincides with key checkpoints in China's domestic economic calendar, including fiscal reviews and trade metrics reporting. Aligning tariff relief with that timeline could amplify its signaling effect across markets. For US negotiators, the offer, if confirmed, presents both an opportunity and a test. It may be read as a chance to unlock short-term economic relief, but it also raises the bar for what Beijing expects in return. Ultimately, this is not a gesture of goodwill. It is a move calibrated to gain international credibility, ease business pressure at home, and test Washington's readiness to reciprocate with clarity and consistency. But China's tariff shift is just one side of the equation. The US is now laying out a far more assertive list of demands. As trade negotiations intensify, the US has laid out a firm set of demands to China, including expanded market access, tougher fentanyl enforcement, and relaxed restrictions on rare earth mineral exports. These requests reflect the widening scope of US trade priorities, moving beyond tariffs into structural and strategic domains. Washington is no longer seeking just economic balance, but also geopolitical safeguards. The rare earth issue is particularly sensitive. China currently dominates global supply chains for these critical minerals, which are essential to everything from electric vehicles to military technology. The US wants more reliable and less politically exposed access. On fentanyl, pressure is mounting domestically. With the synthetic opioid fueling a US public health crisis, Washington is demanding verifiable action from Beijing, especially on precursor chemicals traced to Chinese suppliers. As for market access, US officials are pressing for fewer licensing barriers, better IP enforcement, and more predictable conditions for American firms operating in China, areas where progress has historically stalled. Taken together, these demands set a high bar for any agreement, shifting talks from transactional bargaining to systemic restructuring. And with public frustration rising at home, the pressure is now on the Trump administration to show that its strategy is delivering results. The Trump administration is under growing pressure to deliver tangible progress in trade negotiations, as domestic frustration with the current tariff regime mounts. Public sentiment has shifted, with many voters skeptical about the costs and unclear benefits of ongoing trade tensions. The White House must now show that its tough-on-China stance is producing measurable outcomes, be it improved market terms, lower deficits, or geopolitical leverage. Without that, the risk is mounting voter fatigue. The challenge is especially acute in key swing states, where export-driven sectors like agriculture and manufacturing have borne the brunt of Chinese countermeasures. Support for tariffs is no longer a given, even among Republican voters. With an election cycle looming, optics matter. Trump's team needs more than just strong rhetoric. They need a narrative of economic wins that resonate with working-class voters. Failing to shift the perception around tariffs could leave the administration vulnerable to political attacks, both from Democrats and from within the Republican Party itself. Even Trump's closest advisors are sounding the alarm, citing America's internal instability as a strategic disadvantage. Peter Navarro, former White House trade advisor, has pointed to a critical vulnerability in the U.S. approach to China: policy inconsistency. Compared to Beijing's centralized long-term strategy, the U.S. suffers from frequent shifts in leadership, priorities, and enforcement tone. Navarro argues that this lack of stability weakens Washington's credibility in negotiations. Chinese officials, by contrast, often sit across the table with the same team over multiple years, enabling them to build continuity, accumulate leverage, and exploit gaps in U.S. alignment. The strategic cost of this inconsistency is not just symbolic. It limits America's ability to present enforceable long-term terms, reduces trust in bilateral agreements, and encourages Beijing to delay or dilute commitments. Navarro's critique underscores a broader truth. Effective diplomacy requires predictability. Without it, even the most aggressive positions risk being seen as temporary political theatre. This internal weakness, if unaddressed, could repeatedly undercut U.S. leverage, not only in trade, but across a range of strategic engagements with China and other rivals. And even as trade policy wavers, Trump is now floating a new tax target, this time aimed squarely at America's highest earners. In a notable pivot from his signature tax stance, Donald Trump has floated the idea of imposing a 39.6% income tax on individuals earning over $2.5 million annually. The proposal is positioned as a way to offset the cost of broader tax cuts elsewhere in the fiscal framework. This marks a shift in Trump's economic messaging, balancing populist tax relief with a gesture toward fiscal responsibility. While the move targets ultra-high earners, it also seeks to preserve middle-class tax benefits without ballooning the deficit. The proposed 39.6% figure echoes pre-Trump-era top tax rates, suggesting a potential recalibration rather than a wholesale ideological reversal. Still, the optics of taxing the wealthy could have implications for intra-party alignment. Strategically, it may serve to blunt criticism that Trump's prior tax cuts disproportionately favored the rich, especially in an election cycle where economic fairness is under heightened scrutiny. Whether this proposal gains traction remains uncertain, but politically it sends a signal. Trump is aware of fiscal optics and is willing to adjust the narrative. But Trump's message to the wealthy is mixed, offering support one moment and warning Republicans not to overreach the next. Donald Trump has delivered a conflicting message on tax hikes for the wealthy. On one hand, he supports the idea of increasing taxes on high-income earners as a way to fund middle-class relief. On the other, he cautions Republican lawmakers against advancing such policies independently. This dual stance reveals both political calculation and ideological tension. Trump appears to be navigating between populist messaging and the conservative tax orthodoxy that still dominates large parts of the GOP. While signaling openness to taxing the ultra-wealthy helps reposition Trump as a defender of working Americans, warning his party not to move unilaterally keeps him in control of the economic narrative. The ambiguity may be deliberate, allowing Trump to test voter sentiment without locking in a definitive policy stance. It also reflects a broader struggle within the GOP over how to respond to income inequality without abandoning tax cut principles. Ultimately, this signals a campaign strategy built on flexibility, keeping multiple constituencies engaged while maintaining negotiating power over the party's fiscal agenda. Meanwhile, gridlock looms on Capitol Hill as deep divisions threaten the passage of any major spending legislation. Observers note that the likelihood of passing any large-scale budget packages with contentious provisions remains slim. The main obstacles, widening fractures within the Republican Party, and persistent gridlock between the House and Senate. Even within the GOP, deep ideological divisions are making consensus increasingly elusive. Fiscal conservatives are resisting new spending, while populist factions demand visible economic wins, often in direct conflict with budgetary restraint. At the bicameral level, legislative alignment is fragile. With the Senate under different leadership dynamics, even bills passed in the House face procedural deadlocks or amendments that dilute their original intent. As election cycles approach, political incentives increasingly favor obstruction over compromise, turning budget debates into platforms for positioning, not policymaking. The result? Prolonged uncertainty for federal funding priorities, undermining long-term planning across sectors like defense, infrastructure, and healthcare. As Congress stalls, Trump looks abroad, preparing a Middle East tour aimed at economic and geopolitical leverage. Donald Trump is scheduled to travel to the Middle East next week, with a dual focus: attracting capital from sovereign wealth funds and advancing geopolitical and economic agreements that align with his broader strategic agenda. This upcoming tour underscores Trump's effort to reassert international economic influence at a time when legislative momentum at home is slowing. Sovereign wealth funds in the Gulf represent not just capital, but geopolitical leverage in an increasingly multipolar world. Targeting sovereign funds is a calculated move. Gulf states are seeking diversification from oil revenues, while Trump is seeking alternative sources of capital to finance infrastructure and technology projects without relying solely on domestic appropriations. Beyond the economics, Trump's agenda includes brokering or reinforcing regional security alignments, tapping into overlapping interests on Iran containment, defense procurement, and cross-border logistics. For Trump, a successful trip could showcase deal-making credentials on the world stage, projecting leadership and stability at a time when domestic politics remain volatile. But this Middle East mission may also carry personal stakes, with Trump eyeing a legacy-defining diplomatic breakthrough. One of Trump's major objectives on his upcoming Middle East trip is to expand the Abraham Accords, potentially advancing diplomatic normalization between Saudi Arabia and Israel. Such a breakthrough would mark the most significant step yet in US-brokered regional realignment, offering Trump the opportunity to frame himself not only as a deal-maker, but a peacemaker. The stakes are high. Saudi-Israeli normalization would carry strategic, economic, and religious significance, impacting everything from regional security coordination to oil diplomacy and pilgrimage dynamics. For Trump, the symbolic value could extend beyond headlines. A successful deal could become a central pillar of his legacy and a potential platform for a Nobel Peace Prize bid. Yet, diplomacy at this level requires not just ambition, but durable trust, something that has historically eluded US mediators in the region. But beyond diplomacy, high-stakes talks are also quietly unfolding, with Washington and Tehran preparing for a new nuclear showdown. The United States and Iran are preparing for a new round of indirect talks in Oman, with the primary objective of preventing Tehran from advancing toward a nuclear weapons capability. Unlike the broad-based negotiations of the former JCPOA framework, this new engagement is narrowly focused on containment, not comprehensive rollback or sanctions relief. For Washington, the strategic shift reflects reduced expectations. With formal diplomacy stalled, the emphasis now is on tactical de-escalation, avoiding a near-term breakout while leaving broader agreements off the table. Tehran, under growing internal and external pressure, may view limited talks as a way to avoid additional sanctions or regional confrontation without making binding commitments. The format, held via intermediaries in Oman, underscores how fragile the channel has become. What's on the table is crisis avoidance, not diplomatic normalization. From tariff brinkmanship to nuclear brinkmanship, US strategy now spans trade, tech, and geopolitics, with each front demanding both discipline and leverage.